Hello and welcome to tonight's webinar. I'm going to make a few adjustments here and then we will get started. We'll get started right at 7 o'clock. I'm just doing some final prep work. The Social Security Administration had made some updates, so I'm fixing one slide. Other than that, we're good. So I will see you in about 6 minutes. Hello, everybody. Again, we will get started here in about 5, 6 minutes. And Social Security Administration recently had made a few changes. So I want to make sure I updated everybody since you're on this webinar regarding Social Security, some of the updates. So I'm just fixing one slide and then I will be back and we will get started here right at 7 o'clock Eastern time. So right about 5 minutes from now. Terry here. We're going to get started here in just about 3 minutes. It's almost 7 o'clock Eastern time, and I made a couple adjustments to the slide, so wanted to update that. And we will get started again in about 3 minutes. Excited to show you some of the updates to Social Security Administration and how you can maximize your income. And we'll get started here in just a minute. Hello, everybody. Terry here. We're going to get started. It is roughly 7 o'clock Eastern time. If you are watching this on LinkedIn or um, Zoom's live, but some of these other softwares or social media platforms, it is delayed by 2 to 3 minutes. So I wanted to go ahead and get fired up. We have a lot of people here on Zoom, so I want to go ahead and get started on time. So again, my name's Terry Martine, and we are going to talk about how to maximize Social Security night tonight. And also, we've added one little extra, and I see a lot of folks that are asking me a lot of questions about Roth IRAs and how you can maximize or lower taxes in retirement. You know, for every dollar that you save in retirement by not paying taxes, another dollar you can spend. So I feel it's important add on to this workshop. So we're going to cover that in the last 5 minutes or so. And let's jump right over to the webinar. Okay, so tonight is going to be specifically for maximizing Social Security. For some of you that you've been on these workshops before, you know that we cover Medicare and some other things. Tonight, though, will be about how to maximize your Social Security and again, how to lower your taxes. Now, just a quick disclosure. I am not a CPA. We'll talk a little bit about taxes towards the end. Also, I'm not with the Social Security Administration, so I am giving you Social Security information tonight, but I do not work for Social Security. Um, you'd have to contact them for specifics. However, I will say that they are told not to give you too much advice. If they give you bad advice, it's really on you because they will again refer back to the fact that none of their employees give advice. So, anyhow, kind of a double-edged sword there, but you need to get your information somewhere on how to maximize Social Security. So you come out and talk to advisors like myself. So a little bit about myself, though, is I've been doing retirement planning for over 2 decades. I am here in South Florida. I've got several hundred clients that I've walked through this process. And as you'll see here, when we get towards the end, there are a couple of tricks and a couple of secrets that you need to know in order to maximize your Social Security. And if you haven't started it yet, there's a couple of twists in order to maximize your income, especially if you're relying on Social Security. All right. So we'll jump in here. Now, you can maximize your Social Security, and you have two options. One is that you can download our workbook, which you will get for free. And it's kind of a self-help thing. It'll take you through the process. It's not as robust as option number two. And option number two is to really have one of us or my staff walk through and provide you a detailed report on Social Security, how to get the maximum amount out of Social Security, and also your investments. So there's a couple of twists to that. that is available if you choose option 2, where we do the heavy lifting for you. And it's just as easy as ordering your workbook. You just click a little box and one of us will reach out and try to set up a time where we can help you do that. All right. So why is Social Security such a hot topic? It's because there's so many people entering or starting to get Social Security. All right. So there's 12,000 every day that are initially getting Social Security. All right. So that's a lot of folks. A little over 3.5 million people per year. And that's going to continue now for the next 10 years. So, what does that mean for you, or what does Social Security really mean for you? Now, most people rely on Social Security, but think of Social Security as your security blanket in retirement. And it's really to help you so that you don't outlive your money. In other words, for longevity risk, Social Security means a lot to you. So the difference is if you start early or whether you start it when you hit age 70, we really need to pull this apart for you and figure out what works best for yourself. So, and again, the reason why it's such a big part of everybody's financial plan when they retire is that at least here in America, most corporations have eliminated their pension plans. Now, if you're fortunate enough to be working for the government or municipality, school district, something that offers a pension, feel yourself lucky. But by and large, most Americans in corporate America are not getting pensions. So here's some of the questions that you need to ask yourself. Do you insure your home? Obviously, you do. You have homeowners insurance. Do you insure your car? Auto insurance. Um, insure your health. Obviously, you have health insurance of some sort. And you really need to, again, um, Social Security as your as your retirement plan, but it also insures you for longevity. And that's really what we want to do, because the difference of taking it at 62 and taking it at 70 is a huge difference, especially if you live a long, healthy life into your 80s. It could be 30% or more if you wait. And we'll show you some of the ways you can wait and how you can fill in some of the gaps by waiting every year. All right. So again, Social Security. Now, we talked a little bit about this, but it's really to ensure you against longevity. So if you have two folks, husband and wife, 65 years old, you have a 50-50 chance of one of you living to age 93. So that's a long time. Now, I always get the question, where is the break even? When we'll have a chart that shows you that. Because not everybody should wait until age 70 to start Social Security. So this is the oldest living person as of now. Unfortunately, I had to replace this slide a couple of weeks ago, but she is 116 years old, lives in Japan, and that's a long time to be living. So making sure that you're maximizing your income in life is absolutely imperative. So our focus for today is really quite simple. We're going to talk about Social Security for married couples, the ground rules for benefits, options for divorced individuals, and also if you are a widow or widower, we're going to talk about the options for that. And again, excuse me, we're going to talk and wrap this all up with how to save taxes at the end of the presentation. So, what are the basics of Social Security? First off, how do you qualify? So I think it's a little bit, I get quite a few questions of how you qualify. And really, you need to work for a covered job. In other words, you need to be paying into Social Security. There are some municipalities and things where you don't pay into Social Security, and it really lowers the amount you get. But Social Security covered job, and you have to work 40 credits, which is 1/4. So for every year, you get 4 credits. However, for every month or every quarter, you have to earn at least $1,500 to qualify. All right. So there's a low bar, but it is a bar. So you can't just work part-time jobs and qualify for Social Security. You actually have to earn more than $1,500 a month in order to get that. And it also looks back at your highest 35 years. So you need to have kind of an extensive career if you're going to be qualifying for your own benefit. Now, there are other benefits you can qualify for, but for your own benefit, it is your highest 35 years. So if you only work for 30 years and you're going to get 5 zeros posted to your average because it does look back your 35. In addition, if you work 45 years, it doesn't matter. It only takes your highest 35. The other 10 years that you worked will not count. All right. And you have certain exclusions or reductions. And mostly this is for government folks, windfall, government pension offsets, that kind of thing. I will say that if you lived in Canada for whatever reason, we have a lot of Canadians that we do retirement planning for. If you get the old pensioners, I forget exactly what it's called. Anyhow, there's a Social Security for folks in Canada. It's called old pensioners, something or other. But anyhow, if you're getting money there, it will offset your Social Security here in the States. So I know you qualified it here for this in the States, but that will lower the amount that you do get paid, unfortunately. So how does Social Security work? Now, you as a worker contribute 6.2% of your income up to $168,000 here in 2024. And it does go up to 176,000 in 2025. So what does that mean is that once you reach that threshold, if you're a high income earner, you no longer have to pay into Social Security out of your paycheck. All right. Now, the employer matches the contribution of 6.2%. So that means 12.4% goes into Social Security. And remember, Social Security is one of those things where you're paying into it. However, even though you're paying into it, it's not accruing for you. In other words, it's not like a bank account where the money is waiting for you to start deducting it. That would probably be better. It'd be a lot more solvent if it were set up that way. However, really, it's set up like a pyramid scheme. The money you put in today goes right out the back door to fund all the other people who are taking out of Social Security. And for for you yourself that are putting into Social Security right now, there is about 5 people using your amount of money that you put in and getting their Social Security. So anyhow, that's why the system's going bankrupt. And it's really, they're going to have to make some changes here. And there's a couple of things we should talk about. First off is that it's been in the red now since 1983. So there's no real surprise there. You see it in every newspaper come election time. It's always something that both parties talk about. But they can't cut it. They could certainly try to reduce it, but that would be for younger folks. But there are roughly 70 million people in the United States getting Social Security. Now, it is fully funded through 2035. I put the asterisks on here because it used to be longer. It's 2037. More and more people that use Social Security obviously drains it quicker. In addition, it assumes that people are waiting to retire. If people start retiring earlier, which happened during COVID and some other things, that number actually went down. So it's 2035 as of today. Don't expect that number to be 2035 if you're waiting, like myself, in my 50s, late 50s. But that number is going to come down. All right. So be aware of that. And it is only funded in 2036, 83 cents on the dollar. Again, that is the numbers as of today. It certainly is going to change over the next couple of years. Now, there's a couple of proposals to help improve solvency. Now, they did talk about this at the latest Social Security meeting. So these are some of the things. They can increase the minimum retirement age. As you may know, it's 62 today. They could make it go up to 64, 65. By the way, when Social Security first came out, the average life expectancy was about 65 years old. And when you got Social Security, when it first came out, you had to be 65 in order to claim it. Today, the average age for somebody is about 77, depends on what you look at, 76 to 78, depends on your ethnicity too. But nonetheless, um, in order to make it like it was when it first came out, they would have to raise it so you couldn't get Social Security until age 70, 78. They certainly aren't going to do that, but that's the way it should have incrementally crept up. They didn't put in that provision, but that's one way it could be. Um, Increase it from 62 to 64, 65. Increase full retirement age from 67, which is the highest now, to age 68. And they just break down the percentages as it grows. And increase the payroll tax. So they could start saying, okay, employers, employees, instead of putting in 6.2, let's make it 7.2. Or let's say employees keep it at 6.2 and employers now have to put in 10. There's all kinds of things they can do to hide it from consumers like you and me. But at the end of the day, if your employer is having to pay 10%, then that's just an additional 10% that you're not getting. So that isn't a good way to do it. And they could always reduce benefits across the board. They could say, all right, well, everybody's getting 100% today. Tomorrow, everybody gets 95%, 93%. So again, they'll do some sort of combination of one of these four, if not all four. And that's the only way that they're going to keep it solvent for the program itself. Now, we could always throw money in, print money and throw it in there. It's not advisable to do that. But that certainly could happen as well. All right. So how are your benefits determined? And you can pull this up based on your lifetime, but this is assuming that I made it easy for me to show. But it's 75% if you retire at age 62, 132% if you retired at age 70, and full retirement age for this example is age 66. For most of you that are probably watching here, it's 67. So this would in turn be 100. But for ease of demonstration, just so you know, it goes up about 8% per year every year that you wait. All right. So that's the easy way to look at it. 8% per year that you wait. And it's not 8% per year that you wait. It is 1/8, or I'm sorry, 1/12 of a percent every month that you wait. You don't have to wait a full year in order for your Social Security to go up. It is actually every month that you wait. All right. So that's how they're determined. There is a graph. You can pull them up depending on when you turn or hit your full retirement age. The acronym for that is FRA. So if you are looking at things and it says FRA, that is the definition. Now, there are three different types of benefits. There's one for you as a worker that you paid in your own benefit. There is a spousal benefit, meaning your spouse, you'll get 50% of your spouse's, roughly. And there's a widower benefit or survivor benefit where you would get 100% of the surviving spouse, of the deceased spouse. There are some caveats to that, so I want to make sure that we cover that real quick. Now, when you go to file, you can file and you will have 365 days in order to rescind your application, pay your money that you already received from them, pay it back, and it's as if you didn't start it. The only time I really see this is we had a client that received a large I think his mom had passed away, so he got an inheritance. It was substantial. So he wanted to go ahead and it was within the year. Unfortunately, we couldn't do it because when COVID hit, none of the workers were working at offices and he couldn't find anybody to take paperwork or take a payment. It was a mess. So anyhow, he just, because he's got money now, he didn't care. He just decided to keep it and move on. But that's the only real reason why I think somebody would really do this. Some of the considerations for married couples. To qualify, you have to be married for at least a year. All right, so that's one. The primary worker must have filed. All right, so that's important too. The primary earner needs to have filed. You had to have been married a year, and you must not qualify for more than half of your spouse. Because if you qualify for more than half of your spouse, you would just get your own benefit. And you can qualify for up to 50% of your spouse's benefit. Um, Not the benefit amount. The PIA means the full retirement amount. So this is where it gets just slightly confusing. All right. So if you're scratching your head, like, I don't understand what the spousal means. Quick example. So John here gets $2,000 a month. Jane here qualifies for half, which is $1,000 a month. Right? You're with me so far? Remember, they had to have been married at least a year. John must have filed. Okay. Jane does not get any benefit until John files. And it's 50% of the spouse's benefit. So you say, okay, I think I got it. What does that mean? First off, there are penalties. If John files early and gets a reduced benefit, his wife gets a reduced benefit. All right. If John files later, John gets an increased benefit. His wife, however, does not. The maximum that his wife qualifies for is $1,000 a month. Even if John let his benefit go all the way to age 70, which, by the way, Jane wouldn't be able to get any money, but she would never qualify for half of his amount. It would always be $1,000 a month. All right. So this is where, if you have questions about this, please reach out to us. We'll be more than happy to walk you through this. This we do sometimes get questions on. It's not as easy as it should be. Anyhow, the survivor's benefit is pretty simple. At the death of the first spouse, the surviving spouse can receive a maximum of their own benefit. In that John Jane example, if John were to pass away, Jane could get her own benefit. She could get John's benefit, or she could get 82.5% of the deceased benefit if they filed early. Remember, even if he filed early, she in turn does not get a full amount of the benefit. All right. So keep that in mind. If filing early really does affect you, but it also can affect your spouse. All right. Some of the common mistakes we see is that the higher wage earner files early, which shortchanges the spouse, because if the higher income earner files later, then the surviving benefit is higher for the surviving spouse. All right. So that's one. Two is that both delay past full retirement age and no one claims a spousal benefit. This is a big one. And we do want you to get a spousal benefit. But again, remember, and it's not that big of a gap, but again, the software will show you how to figure that out. Now, some of the considerations if you are divorced, you had to be married for 10 years, right? That's a big one. Now, you could be married to multiple people for 10 plus years. You only have to be married to one particular person, or 3 or 4, but you have to have been married for at least 10 years or more. All right. So that's number one. Number two is that you currently cannot be married. If you go and get remarried, then you are under spousal rules. You can't get divorce rules. Divorce rules are negated when you get remarried. Now, same benefit amounts and reductions apply for claiming as they do regular spousal benefits. Remember, we talked about there are certain issues that you could, in theory, be getting a smaller amount. And if you were independently entitled, in other words, you got to be divorced 2+ years. So you can't run out and get divorced and then claim spousal or divorced spouse benefits. There's a 2-year window there that you have to go through. And then you can apply for divorce benefits. All right. But you have to be divorced for 2 years. Some of the common questions we hear about those who are divorced. So here's the biggest one is that does my spouse know that I'm filing on their claim? And the answer is no. File, they won't know unless you're talking to them. They'll never know. Social Security Administration does not notify them in any way. All right. So some of the considerations for widow and widower benefits. Some of the qualifications, you have to be a widow or widower. That's easy one. You need to be 60 years or older. This is one of the issues with this is that you do not have to wait to age 62. You can get widow or widower benefits at age 60 or older. You have to still be unmarried. You can't be remarried unless you are over age 60. Once you hit age 60, you can get remarried and get your widower benefits, but you have to wait to age 60. And you have to be married for at least 9 months. And there are special exemptions to this. Let's say you're a married couple in the military, husband or wife goes overseas, gets killed in action or something. They know that they will make exceptions to this, even though they were freshly married. So what obviously people have tried to manipulate the system. And somebody had cancer right before they die. They say, "Oh, well, you should try to get my benefit. Let's get married right before they die, just for trying to squeeze some money." But that avenue will be closed. Anyhow, it doesn't work. But people tried. Widow client example. So John never elected for his benefit and died 64. So this is an example. I like this example. I made it pretty clean. If somebody came to me and said, "Okay, I qualify for widower benefits, or widow benefits, what should I do?" All right. So somebody comes to us and says, "Yeah, John, my husband at 64 died. His benefit would have been 2,150. Jane here, her benefit, she was 5 years younger. She remained unmarried. This is important. Remember, if you get married again before you're 60, then your widow benefits go away. Jane's estimated benefit was 1,197 when she turned 62. All right. So when she turned 62. So this is it. John's benefit is 2,150. Jane's benefit is 1,197. All right. So there are three options of what Jane could do. Strategy one is that she could file at age 60 for the widower benefits. We're going to assume that she's going to live to age 85. And she would get $461,000 from Social Security. Say, okay, that looks good. Strategy number two, however, was that she could file for retirement age 62 on her benefit, which again was 1,197, and then switch to the widower benefits at age 67, or his benefit, or widower benefits at 2,150. And that got you $538,000, which is about $70,000 more in retirement. So that's not bad. Now, in order to do this one, you would have to wait 2 more years if you were planning on 60 to age 62. You end up with better benefits, though. And strategy number three is kind of a hybrid of both. You file at age 60 for the widower benefits, so you get 1,537. And then you switch to your own benefit, or she would switch to her own benefit at age 70, which would give her 2,108. So you can see then her benefit now is 563,000, which is approximately $25,000 more. So you say, all right, just by knowing how the system works, we were able to get her roughly 30% more in her retirement benefit from Social Security. All right, so number one question we always get is, can you work and still get Social Security? The answer is yes. However, I will say this. If you are going to work, you need to be careful. As long as you earn under $2,000 or $22,320, it's fine. Social Security will pay you 100% of your benefit, no issue. The second you go over 22,320, the Social Security Administration is going to claw back $1 for every $2 over the limit. So if you are going to retire or not even retire. If you say, you know what, I'm 62, my benefit is, $22,000 a year. I'm going to make $60,000 because I just want to get that extra money. You will get zero. All right. Just so you know, I had somebody come to us and she listened to her neighbor. I said, you're not going to make any money. She happened to work for the school district. She was making 70 some $1,000s a year. I said, why would you apply for Social Security? She goes, well, my neighbor told me I should do that. I go, why do you think you should do that? I said, you're not 67 yet. She goes, well, I figure I could use the extra $20,000. I said, no, you're not going to get anything. Um, they are going to basically hold back all of your benefit and you're going to lock in at a lower benefit. You're really cheating yourself out of a 30% increase. I said, we should wait until after you hit age 67 at a minimum, because you're still going to work. At that point, you can start your Social Security, although I would say not to, but you could. And that way you get your Social Security paid to you. She goes, no, 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 I'm getting paid. See, the thing is with Social Security Administration is that they don't know initially. They'll start sending you checks. Then when you file your taxes, they're going to say, oh, you know what? You earn too much money. We are not going to pay you at all. So it was a big mess. I felt bad for her. I told her, I said, look, you are getting some payment now because they haven't realized, it hasn't caught up to you yet. Pay that money back and then stop your Social Security. Remember, you had 365 days. She's like, no, no, no. I think I'm just going to keep getting it. I was like, no. And eventually, you know what happens. The government may be slow, but they're thorough and they're very efficient eventually. So she ended up not getting any money. And now she says, I should have listened to you. I'm like, well, I tried to help you, but anyway. And of course, if you earn more than 59,500 in the year you turn 67, which is typically for your full retirement age, they take some of that money back as well. So next section is on tax. So Social Security is one of these things that has its own tax rules. It's called provisional income. And really, it's the IRS's way of doing some income-based weighted. If you're Bill Gates, you really don't need Social Security. All right, let's face it. If you're somebody that's retiring and that's all you have, you absolutely need 100% of it. So it's a means weighted test to see how much of your Social Security you'll need to add to your ordinary income in order to pay taxes. All right. So it's not the amount you pay taxes, or you don't, if you're 50% of your Social Security gets taxed, it gets taxed as your normal income rate. So again, a quick example. Let's say you had $42,000 in income for the year. $24,000 came from your Social Security. $12,000 came, I'm sorry, in order to figure out your provisional income, your Social Security gets divided by 2. All right. So half of 24,000 is 12. You had other income come in from either pensions or investment earnings or anything like that. So you had $42,000 in provisional income. All right, I want you to remember this because we're going to come back to this slide here in a second, but $42,000 in provisional income. So if you're a single, 42,000 is here under or over the $34,000 mark. So 85% of your Social Security gets taxed. 15% is tax-free. 85% of it will be taxed. All right, so that's important. And then $42,000 falls in between 32 and 44. So if you're a married couple, 50% of your Social Security, which again was this amount, will be taxed at your ordinary income rate. All right, so you need to understand that, because there's a way that you can reduce your taxes in retirement as long, by the way, if you earn less than $25,000 in provisional income as a single person, you pay zero in tax. Okay, that's important to know. And if you are married, by the way, this should be 50. Again, it's the government, IRS manipulating the system here, but 32,000 if you're married, you'll pay zero in tax. You say, okay, well, that's interesting, but why are you mentioning that? Because certain types of income are not considered provisional income. Remember, that's a totally made up way for the IRS to figure out how much your Social Security gets taxed. Again, we got $30,000 that came in addition to your Social Security, but all $30,000 was provisional income for the sense of making this calculation. But there are three types of income that do not, meaning that none of this $30,000 was derived in one of these three manners, right? First thing is Roth IRA or 401k distributions. Roth 401k and IRAs do not count. So if this in turn would have been $30,000 that came out of a Roth, it would have been zero, except you would have been taxed at 0%. All right. So it's important to know that. So Roth, this is why towards the end here, we talk a little bit about Roth conversions. All right. Two is depreciated real estate. This gets a little bit in the weeds for some folks, but for those of you who have real estate, know that you typically are depreciating this like a 30-year schedule, or if it's commercial, faster. But you are depreciating the income. And if you're able to depreciate all of the income or offset the income for depreciation, this in turn becomes zero. And three is cash value life insurance. Of course, if I knew how to spell, that would be LIFE instead of LIVE. Again, I just made some modifications here. So yes, I did screw that up. All right, so cash value life insurance. So the interesting thing about that is that you can accumulate money in a cash value life insurance policy. And then when you go to take the money, you're actually taking it out as a loan. You're not taking out the amount in the life insurance policy. It does go down, but you're taking out a loan. And your death benefit covers the loan when you pass away. So let's say you had $200,000 in your life insurance policy. You took $100,000 out in your lifetime. The death benefit's $200,000. So your death benefit now just becomes $100,000. So super simple, but those are the three types of income that are most commonly used to offset your income during retirement. All right. Now, one thing that does, if you are in one of the high income states, and you know if you are, California, Illinois, Jersey, New York, a couple others come to mind. But if you're in one of these high income states, Massachusetts, municipal bonds, a lot of folks buy municipal bonds because they're not taxable. However, on income tax, however, they do count towards this provisional income. So let's say you got $30,000 in municipal bond income. It does count as provisional income. Doesn't count for you to pay taxes on it, but it does increase the amount you pay on tax on your Social Security. Remember, under a certain threshold, it's zero, but over a certain threshold, you actually pay tax on. So anyhow, again, if you come see us, we'll be more than happy to put this together for you and show you kind of the plan for how you can reduce tax in retirement. So here's a quick example. This one's super clean and easy. Married couple, 64, 62. This example is going to show you how, if you maximize Social Security, it can increase the amount you get during your lifetime. But not only that, it's going to show you how you don't run out of money. All right. The important thing here is how to not run out of money in retirement. $34,000 in Social Security if they file at age 62. Starting with retirement savings of $750,000 roughly in a 401k IRA. We're going to assume that in retirement, they're going to earn 6% annual return. 3% is going to be inflation. And they need $70,000 a year in inflation adjusted after tax income. And again, we always add a life expectancy. So we're going to say they're going to live to age 86 and 89. All right. Super clean example here. The red line is how much money they need. You see it goes up every year, 3% cost of living. The orange line is how much they're taking out of their 401ks. The blue line is if they started taking Social Security early. Remember, this is showing you how much you did if you took money out early. And this is how much they need. You'll notice that there's kind of a gap here. And you might say, all right, well, I see I'm into it 23 years in retirement, but there seems to be something missing here. And what does that illustrate? Essentially illustrates you run out of money. All right. This is an example of what happens if you take Social Security early. Now, on the flip side, we say, okay, what if we delayed Social Security and we used remember, you still need $70,000 a year initially, year one, and it goes up by 3%. But you'll notice that they don't run out of money. And the reason being is that Social Security helped offset some of the risk. Remember, this is what Social Security does for you, is that it helps you against longevity risk, right? So it kept them in money all the way out 35 years because they decided to wait on Social Security. Now, they did have to fill the gap, and they did that by using the 401k. Again, if you come see us, we have an illustration that's going to show you how all this plays out. But again, you've got an additional amount of money here when you are later in years. By the way, it's one thing to go live with your family if you want to do that later in life. It's another thing if you have to. All right. So just by delaying, this is the advantages of delaying your Social Security. They were able to increase 30% of their Social Security. All right. They increased the amount they were able to get out of Social Security by $186,000. Right. So that's not chump change. 30% additional Social Security, 14 years worth of additional income. Remember, they ran out of money if they had taken it early. And they also paid $35,000 less in taxes, even though they had 14 more years of income. All right. So you made 30% more in Social Security. You're able to increase the number of years your income lasts you, and you're also able to reduce taxes. Again, this is why we offer this class, because a lot of folks don't understand that if they just make a couple of tweaks to their Social Security plan, then they can outlast or, increase their chances of a prosperous retirement. So a couple of things about your statement. There are no cost of living increases applied. For instance, this year, the government increases at roughly 3%. When you get your statement, it's going to underrepresent the amount you get later in life. It's also going to assume that you're going to work to age 62, your full retirement age, or age 70. So those numbers are all showing that you are making the same amount that you are making today. So it overrepresents here. First one is underrepresenting. Second one is overrepresenting. And it's for your record only. It doesn't marry your spouse's benefit. There's no spousal coordination here. It is only your benefit. So that's why folks come to see us, is we want to try to coordinate that benefit, make sure that you're maximizing it. And by and large, Social Security Administration, I mentioned this earlier, is that they will not give you too much advice because they don't want to give you wrong advice and be on the hook. All right. So they typically won't give you too much advice. Now, let's talk a little bit about the Roth rollout strategy or Roth conversion strategy. You say, well, why would somebody do this? So why would somebody pay taxes today instead of paying taxes down the road? All right. And this is important for those of you who have $250,000 or more in IRAs. This is really, hopefully paying attention to this because this really could help you decrease your taxes. All right, so here's a married couple, quick example. They're both government workers. They did not need investment income because their pension and Social Security covered most of their needs. And they had about $1.3 million in retirement benefits. All right. So married couple, government workers, they came to me. Actually, this is one of our clients. Roth rollout without a strategy. Here's what happens if you, hopefully you're familiar with the term RMD, or required minimum distribution. If you have, again, $250,000 or more in IRAs, 401ks, not Roth IRAs, but regular IRAs, 401ks, 403bs, 457, you name it. If it is something that when you take money out, you pay taxes on, this is something of concern for you, because later in life, and it doesn't look that bad early on, but later in life, this couple would have been making checks to the IRS. By the way, this is the checks. This is how much you're paying in taxes. This isn't the amount that they're getting. This is the amount that they are writing out to the IRS. You see here in 2046, 2048, they're writing checks to the IRS for almost $300,000. And as they get older, it could be as high as $500,000. They only started with $1.3 million. So this is what I'm saying is, as far as compounding goes, this is why it's so very important to make sure that you are looking at these strategies and applying them to your retirement. All right. So this is using a Roth conversion strategy. Now you will see that the red line is they are paying more in taxes earlier on. And all the green line is money that they are saving down the road. They're still having to take money out down the road, and they are paying more taxes in advance. But you say, okay, was it worth it? Right? Because it's one thing to just say, hey, I see red and green lines. I don't know what the heck that means. I have no idea. But what does it mean for them? Taxes with strategies on their lifetime, they pay $1 million roughly. I'm sorry, $1 million difference between using your strategies and not using the strategies. So again, this is if you use strategies, and this is if you did not. The difference here is over $1 million. So this couple could save over $1 million just by doing Roth conversions. All right. There's a couple added benefits to doing this, and I'll share that with you here in a second. But it saves them over $1 million in taxes. It increases the tax-free net worth over $2 million. And it also allows them in the, for charities and inheritance, it gives them about $4 million in inheritance. If they had done the typical IRA, they would have about two, and they would have about $4 million in Roth if they had converted it into Roth. By the way, a Roth does a couple of things for you. Is that when you give the money out of the Roth to charity, or your kids or siblings or whoever you're going to give it to, you've already paid the tax on it. So in the event you were to give somebody $1 million in a Roth IRA or Roth 401k, that's $1 million that goes directly to that person because you have already paid the taxes on it. All right. So that's important to know. Now, again, you have two choices. Your first option is to download the free workbook. The workbook you can get at maxhoursocialsecurity.com. You have to put in www.maxhoursocialsecurity.com. Put your information in there. You'll get you get the workbook sent to you free PDF. Or if you want us to go ahead and do that for you, we give you a little bit more robust reporting. We also show you how to bridge the gap. And also it'll have the added benefit of how to do Roth conversions and lower your taxes. Again, it doesn't work for everybody, but it does work for folks that aren't needing the money right away. or have $250,000 or more in their IRAs. So out of the hundreds of reports that my team and I have run, nobody said they didn't get any value out of these, because it just gives you a clear and concise picture of your retirement and how much money you're going to need in retirement. I mean, you'll have to do a little bit of work figuring out how much money you're going to need, but this is going to show you where that money is going to come from. All right. So here's a couple of reports that you get. It tells you why you should wait, why you should not wait, if it's better to wait, how much more money you'll get out of Social Security if you apply later than sooner. It also show you break even as to whether or not, if you took it at 62, which is the red line, 66 is yellow, and if you waited to age 70, it shows you the break even with your numbers. No guessing, absolutely no guessing. It's going to show you kind of the break even on your, by the way, not everybody should wait. So I should throw that out there, because we had one client, guy came to us. He was 60, I think 61. I don't remember exactly how old. He wasn't 62 yet, but he's like, should I wait? And unfortunately, he had a quadruple bypass. Um, he was on dialysis. He had all these different health issues. And we're like, no way. You should not wait 1 second past age 62. All right. So you should start your benefits right at 62 if your health is bad, and or if your life expectancy really isn't that in your favor, right? Hopefully you live a nice, long, healthy life to age 95, but that's not the case for everybody. So if all we did was one of the following. So again, this is if you get our report. If all we did was show you how to increase, your Social Security by 20, 30%, wouldn't it be worth it to kind of reach out to us and have us run that for you? The other thing is that if we were able to show you how to reduce your taxes between 20 and 50% using the Roth conversion strategy, it would be worth that. Again, I showed you a quick example of the married couple that saves over $1 million in their strategy. And also we could show you how to increase the amount that you leave to your kids and or charities. Would it be worth it? A lot of people find that our meetings are extremely valuable, and it also helps you maximize your Social Security. But not only that, but we're going to help you walk through it in the case that you have any questions. So what you're going to get if you log in to maxoursocialsecurity.com. By the way, for those of you that are on the live call, 1 minute ago, you received a text. The text is the link in order to download your Social Security workbook. All right. So in that Social Security workbook, I'll show you here in a second. So you get your Social Security analysis, you get the workbook for free, whether or not you come see us or not, or whether or not you decide to do a Zoom call with us or not. You do the Roth conversion strategy. We're going to show you how to do that. And next step is to go ahead and download your workbook. And I will take a couple of questions. I am running a little bit late on today's workshop, so I'll take a few. But if you do want to meet with us or have us run the report for you, it's pretty simple. This top part is to get your free workbook. All right. Everybody qualifies for that. If you do not want to meet with us, click no and hit submit. Boom. You're going to get the PDF workbook sent to you immediately. If you do want to meet with us, click on yes. And another form pops up. You pick a time that is part of our calendar. Our calendar is going to go ahead and book a time where we can meet and we can get all your information, either my staff or myself, and go ahead and we're going to get that put together for you. All right, so I usually have 10 minutes, but now we're down to about 5 minutes. So let's go ahead and I will jump over to Zoom. Let me pull up. If you are on Zoom, feel free to click on the Q&A button. The Q&A button is going ahead and shoot us over any questions. If you're following along on YouTube or LinkedIn or Facebook, put it in the description. I'll scroll through those here in a second to see if there's any questions there. But I think the majority of folks are on our Zoom call. All right, first question says, I'm married and I want to do spousal. I'm just paraphrasing here. 57 and my husband is 67. Yeah, in order to get spousal again, you have to wait until you are age 62. You can get spousal, but you have to wait. You can't apply for that early. Unfortunately, you're about 5 years out before you can start that benefit. All right, I had a question regarding Roth IRAs. Yeah, the Roth IRA is money that you take out of an IRA or also, 401k, 457. There are limits if you are contributing, meaning that you're working and you're putting money in. Basically, if I'm not clear on your question, go ahead and you can sign it back to me or ask me again. But I think your question is, I thought there was a maximum IRA contribution limit. There is. It's roughly 7,000-ish. It goes up next year. But there is no limit to Roth conversions. For instance, we just did a Roth conversion workshop or analysis for somebody, and we're going to be converting $140,000 a year for the next 6 years from IRAs into Roths. And that couple will save, I don't know, remember, these are estimates and the software kind of shows us two things with that. One is, it is an estimate, but I think they were going to save, I don't know, I want to say 300,000-ish by doing conversions. And the second part of that is to do Roth conversions. In order to do those properly, we really have to wait until December-ish in order to figure out how much money they were getting, because they were getting pensions. They were also having to take some money out of some inherited IRAs. So they were getting money. So we kind of balance that out, and we don't want to go over, in their particular case, the 22% tax bracket. So we figure out how much money they earned minus the tax bracket for the 22%. And that kind of gives us the window as to how much we could do Roth conversion wise for them in order to save them money. So as kind of a long-winded way of saying that there is no limit on Roth conversions. Now, I will say this though, is that if they, when we do the estimates, for instance, the estimate for this estimated lifetime savings, this is if the tax rates stay where they are today. All right. If tax rates go up in the future, you obviously are going to be able to save more because you're going to be paying more down the road if taxes go up. All right. So that's a big unknown, but we don't take guesses with that. We just assume the tax rates are going to stay the same. And again, this is going to give us an estimated amount, but it's pretty accurate. When you require minimum distributions, every year you go up, you're going to have to take more and more money out. So if you're to the point where you're later in life and you're having to take 10, 12% out of your retirement funds, let's say you had $2 or $3 million in there. That's 300-ish thousand dollars that you have to pay tax on, in addition to whatever else money you got. So that's why it can push you up into the tax bands considerably. And that's why we add that to this workshop. All right. So again, maxhoursocialsecurity.com. If you're watching this on the recording, that's the website you want to go to download your workbook. Again, you'll have access to our calendar as well. Feel free to use that. For those of you who did participate in this, you also will get the invites to other workshops that we do. Medicare investment workshops, income planning, how to put together a financial plan for yourself, for those of you who do it yourselfers. So we do look forward to talking to you in the future. I appreciate you being on the call, and we'll wrap this up. It's been an hour, and I do appreciate it. Again, feel free to reach out, and we'll see you soon. Bye now.